Stop wasting time being confused by the jargons from these mentors and gurus. It's not as complicated as it looks. By the end of this video, you will finally understand the forex market so well that you can start to follow along with any tutorial without being lost or confused. My name is Bernard Watinsichi, but you can call me Nana Kwame. I'm the founder of the QFS Trading Group. I've been trading for over 5 years now and have been teaching for the last 2. And today, I'm going to give you the solid foundation you need to start your forex trading journey without struggle. I'm sure you already know this, but Forex is short for foreign exchange. It is simply the global decentralized marketplace where one currency is traded for a different currency. So unlike the stock markets that have a central exchange, Forex works through a network of banks, brokers, and traders all around the world. Do you know that each day over $6 trillion is traded globally? Yeah, roughly twice the size of the entire UK economy every year. That's amazing, right? There are a lot of reasons why people trade, but traders and investors are mostly attracted to the forex market because of these few reasons, right? First of all, the huge liquidity this market provides, meaning you can easily buy or sell in huge amounts at a go. Secondly, the forex market is open 24 hours a day and 5 days a week, which means traders can come in and go out of the market with ease anytime they please. Lastly, the ability to profit on both rising and falling currencies. For example, if you think the euro will strengthen against the dollar, you can buy the euro USD. And if you think it will weaken, you can sell the euro USD. This ability to go long or short means you can potentially profit in both directions, whether you buy or you sell. Let's talk about leverage. One reason why Forex is popular is leverage. With the help of your broker, you can trade a large position with a relatively small deposit. In the next section, I'm going to break down most, if not all, of the main terms and concepts that are used in the Forex industry. Forex is always traded in pairs. One currency is bought while the other is sold simultaneously. For example, the pair Euro USD compares the euro to the US dollar, right? The first currency, which is the euro, is the base currency, and the second, which is the US dollar, is the quote currency. When we say Euro USD equals 1.20, it means 1 euro equals 1.20 US dollars. Also, if USD CAD equals 1.25, this means 1 US dollar equals 1.25 Canadian dollars. Even though two currencies are involved, a pair behaves like one asset. If you buy Euro USD at the price of 1.20 and later sell at the price of 1.22, you profit from the 200 pip rise. Don't worry if you're a bit confused. We will explain what a pip is in the next section. But before that, you should note that in forex trading, currencies are quoted in pairs, and they are generally grouped into major pairs, minor pairs or crosses, and exotics. Majors consist of the US dollar plus one other major currency. Minors consist of two major currencies paired without the US dollar. And exotics are a major currency plus one other currency from an emerging or less liquid economy, which may be the USD TRY, Euro SEK, and many others. On that note, what is a pip? A pip, short for percentage in points, is the smallest price increment in a forex quote. For most currency pairs, a pip is 0.0001 of the quote currency. Think of pips like cents in a dollar. If Euro USD moves from 1.2000 to 1.2001, that's a move of 1 pip, which is 0.0001. Pips are how we measure profits and losses. For example, If you buy Euro USD at 1.2000 and later sell at 1.2020, that's a 20 pip gain. For pairs involving the Japanese yen, a pip is typically 0.01 since yen rates are quoted to 2 decimals. A lot is a fixed quantity of currency. Forex is traded in standard units called lots. A standard lot is 100,000 units of the base currency. A mini lot is 10,000 units, and a micro lot is 1,000 units of the base currency. Some brokers even offer nano lots of about 100 units. Baby Pips uses a simple egg carton analogy. I want you to think of lots like egg cartons. You buy eggs by the dozen, which means one carton contains 12 units of eggs. Whereas in Forex, you buy currency by the lot, meaning one standard lot contains 100,000 units of the base currency. For example, if you buy one mini lot of Euro USD, you are buying 10,000 units of the euro using the US dollar. Trading in lots makes the math of pips and account balances easier to handle. Yeah, that's how we use lots. So basically, trading operates like auctions. Just as auctions has two prices, the bid and the ask. Every forex quote also has two prices, the bid price and the ask price. The bid price is the price you can sell, and the ask price is the price you can buy. The difference between the ask and the bid is called the spread, and the spread is effectively the broker's fee on the trade. For example, if Euro USD is quoted at 1.2000 is to 1.2002, the spread is 2 pips. In plain terms, it means if you buy at the ask, which is 1.2002, and immediately sold at the bid, which is 1.2000, you would incur a cost of 2 pips. Spreads vary by broker and by currency pair. Major pairs usually have very tight spreads. In short, ask minus bid equals the spread. Now, let's revisit the legendary terms, leverage and margin, and let's elaborate on it a bit. As I stated earlier, leverage lets you control a large currency position with a relatively small amount of money in your trading account. For example, with 50:1 leverage, you could control $50,000 worth of currency with just $1,000 in your account. The broker essentially lends you the rest of the position size. As Baby Pips explains, think of your broker as a bank that gives you $100,000 of cash. All they ask from you is $1,000 upfront as a margin deposit. In other words, with 100:1 leverage, you could control $100,000 with just $1,000 in your account. This allows you to trade large amounts with your relatively small capital. So then, what is a margin? This is the portion of the trade's value you must have in your account to open a leveraged position. For instance, with a 3% margin requirement, buying a standard lot, which is about 100,000 units of Euro USD at $1.20 each, will cost $3,600 as margin, not $120,000. Note that this deposit is not a fee, it is returned when you close the trade, provided you don't lose more than your deposit. Remember, leverage magnifies both profits and losses. A small move against you on a highly leveraged position can quickly exceed your account balance. Always use leverage carefully and consider stop loss orders to manage risk. Forex orders control when and how traders execute. The three basic types for opening trades are market order, limit order, and stop order. Market order executes immediately at the current market price. It's like going into a shop and buying or selling right away without bargaining. or clicking buy now or sell now on an e-commerce shop. You get filled at the next available price without wasting time. Use this when you want to instantly enter or exit a trade. This sets a target price to buy or sell. For example, if Euro USD is at 1.2000 but you want to buy at 1.1950, which is a lower price, you can place a buy limit order at 1.1950. The trade will only execute if the market reaches that price or better. It's like telling the broker, only buy for me if the price hits this target. Limit orders are useful when you don't need an instant fill but want a specific entry or to take a profit on a certain level. An order that activates a trade once price hits a specified trigger. A sell stop is placed below the current price and becomes a market sell order if it gets hit. A buy stop is placed above the current price and becomes a market buy if it hits. Today, we covered the foundations of Forex and also clarified some basic terms used in the industry. In our next tutorial, we will dive into technical analysis and show you how to read charts and identify trading opportunities. So then, stay tuned and happy learning. Peace.